Okay, we're now going to look at problem 62. All right, so here again, 62A. Here again, Part A, neither of them are covered by a plan. They're both under 50 years old, and so Part A is going to be then this $6,000 a piece or $12,000, just like what we got in 61A. Part B is both Cam and Carlos are covered by employer-sponsored plan, and their income is $114,000. So our phase out range now is, again, this 103 to 123, and they are at 114. So we're going to take 123. Again, we're going to use the upper range because it makes the calculation easier. Minus 114, which is equal to 9,000 divided by 20,000, or 45%. Now their total contribution now, because this phase out range applies to both of them, we can take the $12,000 times 45%, and the answer then becomes $5,400. Okay? In Part B, Lois is not covered by employer-sponsored plan, but Cam is. So Lois now has a phase-out range that is 193 to 203. Because they're at 114, Lois is below her phase-out range, and so therefore Lois can contribute $6,000. Cam phase-out range now is this 103 to 123. So we're going to take 123 minus their income of 114. Pause it, please. Is it going?
It's blinking. Yes, it is.
Here we're looking, in problem 67, we're looking at the Coverdale education loan. And here the deduction is limited to $2,000 per beneficiary because $1,500 has already been contributed to each child's account. The additional amount that Patricia can contribute then is just the $500. The difference between the $2,000 and the $1,500 that's already been contributed. All right, 69, education loan deductions. Here, there's a phase out between $65,000 and $80,000 of income. Okay, well, because this is only at $33,000, they're below the phase out, so they're going to be able to deduct the entire $1,400 worth of education loans. Pause it, please.
Okay, got it.
Okay, 69, Part A, because they're below this phase out of 65 to 80, then they're in Part A, they're going to be able to deduct the entire $1,400 of interest they paid on their education loans. In part B, they're in the middle of that phase out. So again, just like we did with the IRAs, we're going to take the top end of the phase out of 80,000 minus their income of 77,000 gives us 3,000 divided by the phase out range of 15,000 times the $1,400 of education loan interest, and this then turns out to be 20% times 1,400 or $280. And that's it for the homework for chapter 6. We'll start on chapter 7 on Monday. I need you all to read chapter 7. And then I'm going to lecture on chapter 7 with the video that I'm going to post on Sunday night. And then if we have a chance, we'll start on the problems then for chapter 7. But for right now, I just need you to read chapter 7 for me, and then we'll post a video talking about those important concepts then from chapter 7. All right. Have a good night. Thank you very much for your patience. And I'll talk to you on Sunday night.